This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, welcome to the last AJ Bell Money Markets podcast of 2024. I'm Dan Coatsworth, and joining me to bring you up to date on the latest economic and market news is Danni Hewson. Hi there, Danni.
Hi, Dan. Hi, everybody. There is plenty of new data to gnaw on as 2024 grinds to a close. We'll assess where interest rates may go next, both here and in the United States, after the Fed delivered a third and final cut for 2024. The Bank of England looks set to stick it out on just two. Also, as inflation in the UK tops an 8-month high, wage growth continues to come in hotter than expected, but private hiring falls at its fastest rate in 4 years. I'm afraid we have to talk again about the potential for recession to return next year.
There's plenty of market news to get you up to date with, including reports that car giant Honda and Nissan could be considering a merger. Of course, there's the long-running saga of whether the owner of Royal Mail will be taken over by Czech billionaire Daniel Kretinsky, because it seems to be that saga is finally coming to an end.
And our guest interview this week is with Jean Roche from the Schroder UK Midcap Fund. She talks through the potential opportunity for those FTSE 250 companies in the new year, and why the fund's policy is to ditch mid-caps if they succeed in climbing into the FTSE 100.
Plus, do you know what Pisces is and why the FCA is consulting on a new private stock market? We'll tell you all later in the podcast. We'll also be assessing what's hot and what's not in 2024.
So this is not going to be a filler episode. In fact, it is another bumper edition, which we hope is going to tide you over for the next couple of weeks, as this is going to be the last Money and Markets podcast of 2024. We'll be back with our next episode on the 9th of January. And I do feel like I need to get my crystal ball out a little bit, because we're going to start with the thorny issue of rate cuts. And I was thinking back to this time last year and December 2023, possibility of rate cuts, the trajectory of rate cuts was absolutely dominating investor sentiment. And I was looking back, and the expectation was that the Bank of England would cut rates no fewer than 6 times. In the end, we've only had 2 cuts, because today we're not expecting a cut. We're recording this on Thursday morning, so a few hours before that decision. You'll already know what the MPC decided and what that vote split looked like, but we felt pretty confident that the data from the past couple of days means we won't get a cut. I was looking at a market expectation this morning, and it was a real eye-opener, because usually when you go on, it's like 96% expecting no change, 100% market expectation, no chance of a cut. That is what markets think. Obviously, as we're doing this, we can't know what is in MPC members' minds, but looking at what analysts are expecting, they're thinking 8-1 voting for a stick. So unless the bank wants to be seen to be lumbered once again with that unreliable boyfriend tag, we're just not seeing it. I'm going to get a bit more into the inflation and wage data that really sealed the deal in a bit, but I want to start on the cut that we did get overnight from the Federal Reserve. The Fed lowered rates for the third time in 2024, so that means the rate there is down a 4 percentage point over the year, because one of those cuts was outsized. It was 50 basis points, and the 2 others 25 basis points. But the bit that was really interesting, the bit that market watchers had been waiting for, was the indication from Jerome Powell of where interest rates in the United States are likely to go next, and whether or not the potential for Trump's tariffs. Obviously, Donald Trump is due to be inaugurated in January. Also, the expectation of tax cuts, whether or not they would be factored in, and how that would alter the expected trajectory of interest rate cuts over the next 12 months. Now, as you would expect, Jay Powell was pretty cautious. He used the word cautious quite a lot. And he was talking about the fact that inflation was still sticky. Looking over the year, he's now expecting inflation to be stuck at 2.5% for 2025, which is better than the annual rate of 2.8% for 2024 in the United States. Stress. But also, he has now sort of been looking then at what the potential for tariffs and those tax cuts might have. And he was saying that when they were doing the dot plot, some of the clever boffins there had been factoring it in. And certainly, we're now only expecting 2 25 basis point cuts in 2025. So that is quite a change in narrative and quite a blow for a lot of investors who really up until the last sort of month or so had been thinking that the Fed would go further, that the economic picture was such that they could cut deeper and harder. And Dan, I think it's fair to say that markets didn't like what they heard.
No, we had the in the sort of the main US equity indices. So the S&P 500 was down 3%. The Nasdaq was just about 3.5%. And then the following morning, because Europe woke up to this news, and we saw things like the FTSE 100 in UK pull back as well. What strikes me as quite surprising is the market seemed to be really shocked by all this. But it was very clear inflation is currently sticky. Certainly looks that way. It was very clear that Donald Trump's policies could drive up inflation. So all these things suggested that the Federal Reserve would keep rates higher for longer. I don't know why everyone seems so sort of shocked by it all, but they did. And I guess it sort of shows that markets have been, they've been racing ahead in the last few months. I think everyone's really excited about the prospect of Donald Trump getting back in, and because he's talking about looser regulation, cutting taxes. Everyone thought that was essentially meant it's party time. Well, the Federal Reserve put an end to that party quite abruptly.
Well, considering he's talking about potentially putting tariffs on things like Scotch whiskey, I mean, that was certainly something that I know a lot of the whiskey manufacturers in Scotland are concerned about. I suppose, that could be an end to a party. Although I stress we've had nothing from Donald Trump yet on tariffs beyond what he said about Canada and Mexico and China. So I know certainly that the potential impact of tariffs is something which the European Central Bank it has been looking at. Of course, it has delivered 4 cuts in 2024, a full percentage point there, and it's predicted to lower them by a further 4 full percentage point in 2025. Political turmoil there, obviously, but also the risk of a trade war. Now, I said I would talk through some of the things which really do seem to have sort of nailed on the expectation that the Bank of England won't cut rates, and also has sent markets thinking that we won't get the 4 rate cuts that Andrew Bailey had been talking about just a few weeks ago in 2025. But it's now more likely, markets reckon, that we'll get 2, potentially 3 rate cuts in 2025 here in the UK. And on a personal note, my fixed rate mortgage comes to an end in December. So I'd really like 3. If we could manage 4, that would be great. But I'd really like at least 3. But I have to say, just looking at the last lot of inflation data that we got yesterday, we're recording this Thursday, as I say, inflation does look sticky. It really does look sticky, particularly when you look at core inflation and when you look at the service sector there, 5% still. And inflation had gone up. It's back up to where it was in March. So, when we're talking about inflation and we talk about the cost of living crisis that we went through, we're nowhere near that 11.1% headline CPI rate that we were at in the autumn of 2022. But you've got to remember that this is still a cumulative effect. So households are still feeling the impact of those price increases at the same time that they are now seeing inflation up slightly again. So we're talking 2.6%, with the expectation that what happened in the budget with those national insurance increases on employers is likely to filter through to price rises going forward. So that, again, will impact inflation, as potentially could any trade war, which might happen once Donald Trump has got himself ensconced behind that desk at the Oval Office. But we also had some data on jobs, and it was really interesting looking at that jobs data that we got a couple of days before, because although unemployment had held steady, vacancy numbers were down again, but wage growth was higher. And I know a lot of that has been down to the fact that we have seen those public sector increases. And also, we knew that the national living wage increase come April was likely to be pretty chunky. So a lot of workplaces had already started to sort of factor some of this into their own pay deals that they've made, because obviously companies make those decisions at different points in the year. So we are seeing still wage growth pretty hot. When you account for inflation, you're talking about 3%. Clearly, everyone is in a different boat, but this is an average. And those two things, the sticky inflation and the wage growth, once we got those bits of data out, markets just basically went, no, big cross. I sort of feel like I need a buzzer sound here, because they just sort of said, look, there is no way that the Bank of England can cut while they are trying to factor in what comes next. And I think a really interesting bit of data that we got, which potentially suggests what might come next, was the latest flash PMI from the S&P. And it was looking at private sector employment. And private sector employment, it said, fell at the fastest rate in nearly 4 years in early December. And that is because firms have continued reacting to the autumn budget. And we also had James Reed from Reed Recruiters talking on the BBC on Sunday, suggesting that what he is seeing at the moment in terms of hiring, in terms of demand from employers, he feels that as a recruiter, he's kind of at the crow's nest. And what he's seeing on the horizon are those big recession warning signs beginning to flash once again. So, you know, at the moment, I think it is way too early to say we could potentially be in for a recession again. But certainly we're not expecting, you know, some kind of white hot economic growth. And I think disappointing growth is a word that I've heard used quite a lot.
Yeah, I mean, these recruitment companies have all been having a pretty tough time recently, and I'm quite surprised when they say that they think it's the signs of recession. It's almost like, I don't know, maybe they're just they're fed up of moaning and they're looking for different things to worry about. I'm not so sure that's going to happen. These economies are sort of slow, but they're not. It doesn't seem to be too troubled. I think the most important thing that you haven't mentioned is that the cost of a Christmas Radio Times is now pushing £6. That's true inflation, isn't it? But yeah,
my husband loves the Christmas Radio Times, I have to say. That's on my list to buy. I hadn't realised quite how much it was. When I go out later on, I'll keep an eye on that. But I can't not have one.
Okay, so obviously we've got Jean from Schroders who will be on the podcast in a bit. She's going to sort of get her crystal ball out to see. But I thought before we hear from Jean, I thought it'd be worth just taking a look to see what sort of things have done really well from an investment perspective this year, and also stuff that hasn't done quite well. So we actually did some maths on this. It was just about a week ago. So whilst they don't sort of obviously capture the sort of wobble that we've had on the stock markets as we're recording this, they give you still get pretty good indication. So if you put money into the US stock market, the Nasdaq's up by a third, S&P 500 is up by 27% this year. I mean, these are really good returns. In terms of the UK, it's 7.4% for the FTSE 100. Of course, if you add on dividends on top, you're probably looking at close to 11% there. But in terms of the asset classes, the biggest one this year has been Bitcoin, up about 130%. So it's quite incredible how this is, 1 minute this is so firmly out of favor, the next minute everyone is talking about it. Obviously, this has been driven by Donald Trump getting back in and being sort of pro crypto. But I wonder, there's really high expectations for him to be sort of this crypto champion, and if he doesn't deliver on that, could we see sort of more volatile performance for Bitcoin and sort of other cryptocurrencies? Other stuff that's done well, gold is up by 30% in the year. That's quite interesting when you consider that there's not many things that haven't done well, but one of them is another commodity, which is oil, down nearly 7% this year. Which, I guess if you're looking for indicators that the economy is perhaps not as strong as you think, oil is always a pretty good one to look at. The other one would be to look at, just what's happening with the metals space, things like copper as well. So, from a stock market perspective, investors certainly seem to have had a good year. Very exciting. But should we talk about some of the individual stocks? So, Danny, I don't know, just put you on the spot. What do you reckon is the best performing UK stock this year?
Potentially one of the utility companies.
It's not. It's actually, there's a sort of collection of three that have done almost the same. They've almost just nearly doubled. And it's Rolls-Royce, NatWest, and the owner of British Airways International Consolidated Airlines. So I think, to see a UK stock essentially double in a year, not very often we get that, but it does show that that there are some really strong movers. The UK stock market is not as boring as you think. I think the one that really catches my eye is NatWest. I mean, that's certainly not a stock you'd expect to double your money in a year. The reason why it's done so well is that analysts have continued to upgrade earnings forecasts. I mean, the company's come out with some really good results this year, improved its margins, saw growth in lending and in savings deposits. I think that a decade ago, lots of people were talking about challenger banks would sort of eat legacy players' lunch. But NatWest is one of those that's sort of shown that the big banks can shake off that competition. These challenger banks might be hoovering up lots of customers, but most of them aren't really making any money. So obviously NatWest has come out, it's done really well. It's focused on efficiencies. It's bought some assets from Sainsbury's Bank and Metro Bank. And I guess, it's all of this is really interesting when you consider that we've got the government has been rapidly selling down its stake in the business. So a year ago, the government owned about 38%. Well, that's under 10% now. And it sort of indicated it will be out completely. So, and just in terms of some of the worst performing stocks on the market, well, there's a couple of retailers, which are Frasers, which own Sports Direct, and JD Sports. So JD was down 42% this year. I mean, so Danny, you've obviously not been buying trainers and tracksuits for your kids.
Well, they buy everything on Vinted now. That's the thing. They're looking for very specific things, specific labels that they can't afford otherwise. So yes, secondhand is the way to go.
So just before we sort of finish this little segment, we quite often talk about the Bank of America's a regular fund manager survey on the podcast. So what the Bank of America does is talks to lots of fund managers around the world and gets sort of their sense of what they're doing and how they're feeling. Its latest report's just come out and it says that global managers are super bullish, record low allocation to cash, record high allocation to US stocks. So the Bank of America team says that the only time that the cash allocation has been anywhere near this low for fund managers came in early 2002 and in February 2011, and they called both of those huge tops in risk assets. So when I read that, I thought, oh, crikey, does that mean that we're due a correction? Of course, this came out yesterday, and then overnight we've had, a pullback in the stock market. But actually, I was just looking at the futures prices, indicating where the US stock market will open this afternoon is recording it, and it looks like shares are back up again. So perhaps it's too early to be negative and sort of talk about corrections, but something to think about going into next year. US stock markets have had such a good time, and historically things don't always go up in straight line. Do suggest we get regular pullbacks, and I have a question: are we well overdue one for the US market?
Let's crack on with some up-to-date markets news now, Dan. And one of the biggest bits of news that came out this week was from the car sector, with reports that Honda and Nissan are talking about a merger. Well, talking about a merger. They haven't made any indication that this could happen, but certainly they've already agreed to explore a strategic partnership for EVs. That was announced back in March. So they have been collaborating, and it was really interesting to watch how the shares performed on the news of that, because Nissan shares were up 20%, but Honda shares were down 2% on the reporting of that speculation. This came from the Japanese business newspaper, the Nikkei. But as I say, we didn't have anything from either of the car companies. But of course, Honda is the bigger of the two companies. And just taking a look at the market cap, so 44 billion market cap for Honda, whereas Nissan only has a market cap of $10 billion. But even so, if you put the two companies together, that would be 52 billion. And I was just looking at a previous deal that had been done. So that was the Fiat Chrysler and PSA merger back in 2021, which then, of course, created Stellantis. And this would be bigger. But you can understand why all of these car manufacturers are having these kind of discussions at the moment, because the car sector has had a really difficult time in 2024, particularly those legacy automakers who are having to change what they produce to shift from combustion engines to electric vehicles, which means changing production lines. It means spending on new models and on new technology. And all of that is happening at a time when we have had customers, motorists, really struggling with how much cash they had in their wallets, which has seen sort of a market collapsing in on itself slightly. But at the same time, you've also had a lot of these Chinese car makers who make just EVs have exploded, and they are able to flood the market with much cheaper cars. And in fact, you're beginning now, when you're driving along the road, to see almost every day, one of the Chinese car makers' cars, which a couple of years ago, you possibly didn't hear about them. So it will be interesting to see whether or not this deal actually goes beyond the drawing board, goes beyond talking points, because, of course, Nissan is also Mitsubishi's biggest shareholder, and Mitsubishi was up as well on the news there. So you would think that regulators would certainly scrutinize whatever deal were to happen. But it's just an indicator of how tough things have really been, because we've seen car makers, particularly in Germany, cutting back very heavily on the number of people that they employ. Certainly, we've seen VW talking about closing factories in Germany, which was, almost unheard of, and is sort of an indicator of the fragility of Germany's economy at the moment. And that's one of the reasons we're seeing such political turmoil there as well. But I think that's certainly one to watch as we go into 2025.
I mean, talking of scrutiny of takeovers, we've had some developments for the £5.3 billion takeover of the parent company of Royal Mail, International Distribution Services, by the Czech billionaire Daniel Kretinsky. So That deal was agreed in May, but was subject to UK government review under national security laws because Royal Mail is considered to be vital national infrastructure. So UK government has now come out and said, yeah, we're happy, we approve this because Daniel Kretinsky's company EP Group have agreed to certain conditions. So Royal Mail's headquarters, tax base, corporate structure will remain British for 5 years under the agreement. Universal service obligation to deliver letters every address in the UK 6 days a week at uniform price. That's also going to remain indefinitely. And the government gets a golden share, so which means it gets a say if there's going to be any major changes to the sort of within the business. So lots of things quite interesting here, but essentially it's still not quite there though. It's got an agreement in principle with unions on the takeover, but we just need that sort of formalised. Then it's down to IDS shareholders. They just need to decide: do you sell your shares, or do you accept the offer, or you don't accept it? So it's only when EP Group owns 75% of the business will this takeover actually complete. And so I think the indication is we'll probably look for the takeover, assuming there's no more hurdles, to go through in the first 3 months of 2025.
Well, sticking with national infrastructure then, and this is one of the reasons that I had utilities on the brain when you sprung that question on me earlier, Dan, is because I've been immersed in the increase in water bills, which has been signed off by Ofwat, the regulator, today. There's been a lot of talk about how much bills should go up by, a lot of campaigners saying that actually, considering the amount of leaks and sewage spills, they shouldn't go up at all. But then Ofwat is saying that we need to deliver significant improvements, and water companies saying, well, we need to charge customers more in order to make those improvements. So today we've got sort of a happy medium of the two. So Ofwat has gone up from the jumping off point that it announced earlier this year. They have not allowed water companies to charge as much as water companies were wanting to charge, but it feels like the sort of meeting somewhere in the middle. What does it mean for you and I? Well, unfortunately, it does mean that our water bills are going to go up, an average increase of £31 a year over the next 5 years, but the expectation from Ofwat is that a lot of these water companies will front load those price increases. So expect next year to see an average hike of £86 a year on average. Now, Ofwat says that it will allow significant reduction in sewage spills and further reductions in leakage. And that is what the extra cash is for investment. And there are lots of different water companies, obviously, and every water company is slightly different. So you might want to just have a look online and see where you stand. But Southern Water, which is ironic considering thousands of its customers are currently without water, they've been given the ability to charge the biggest increase, 53% by 2030, whereas Wessex and Northumbrian Water, the smallest increase, around 21%. A lot of people will be wondering about Thames Water, because Thames Water, we know, is currently going through the courts trying to get sign-off for extra cash from investors to help tide it over because it's rapidly running out of cash. Well, it's been told it can charge 35% more, so an average bill will increase by £152 over the period. The big question now is that enough? Because we know that investment giants backing the plan for this £3 billion bailout had demanded a significant bill increase to facilitate the deal. So we don't know whether or not that 35% will be enough for the bailout to proceed. We do know that it's been through the first of several High Court hearings this week regarding that proposal. I think it's also worth mentioning that it was hit with an £18 million fine over paying what the regulator called unjustified dividends to shareholders. But just for water companies in general, I know that the water utility industry has really lost face over the last few years. Whether or not the news of these additional increases will sort of spark investor interest, it's going to be really interesting to see what happens to some of those publicly listed companies, Pennon United Utilities and Severn Trent, over the next couple of days. We do know that it's potentially not the end of things, though, because Thames Water have an option to appeal the decision to the Competition and Markets Authority if it looks like it is going to impact this bailout. So for those customers, if that is triggered, then it could take months before they learn how much their water bills are going to increase by.
Thanks, Danny. So I just wanted to talk about the proposed launch of a new stock market called Pisces. This has been sort of mentioned a few times over the last sort of 12 months, but I thought it was a good excuse to do it this week because the Financial Conduct Authority, the financial regulator, has started a consultation on it. And really, what the purpose is to help private companies facilitate trading of their shares. I think a lot of people don't realize that you can actually buy or have shares in a private company. The problem is then how do you get hold of them if you're not an employee? So this Pisces market is going to be sort of a help address some of those issues, but it's not going to be open to everyone. You can only trade these shares if you're an employee of the company that's using it, or you're an institutional investor, a high net worth individual, or those deemed to be sophisticated investors. So the way it would work is you got a business. They want to be able to let their staff essentially sell any shares that they've got. They'll help bring in some new investors this way, and really it's helping private companies get used to the idea of their business shares essentially being the ownership being transferred between different people. It could act as a stepping stone towards a public stock listing later on. Certainly get them used to regular financial reporting, transparency business, understanding that it's run for the interests of shareholders, the company, not for the interests of the board of directors. So it's definitely a good idea. Obviously, because there's restrictions on what you can do with it, and in terms of who can participate and buy the shares, it's not going to be for everyone. It's not going to replace a market like AIM because you can't use it to raise money, which is typically the purpose of we'll call it the grown-up stock market that already exists. So, but I think it will fit nicely into sort of the bigger picture of the world of investing, and the government's very much behind it. So something to keep an eye out for in the new year, but just remember it's not open to the general public.
Right, Dan, let's round off this episode with our special guest, Jean Roche, Schroder Midcap UK Fund Manager.
Yeah, it's been quite the year for obviously mid-caps, which Jean sort of focuses on. And, last week we were talking about changes to the FTSE indices, which see some companies leave the FTSE 250 to get promoted to the FTSE 100. But, obviously that's actually the sort of the trigger point for the Schroders Fund to sell their stakes. And so we wanted to find out what was behind that thinking, and also to talk to Jean about what 2025 looks like for sort of the mid-cap space, and how do increases in employer national insurance and the impending arrival of Donald Trump affect companies on the market.
Thanks so much for joining us. Just before we really kick off, for people that don't know, explain what a mid-cap company is.
It was a really interesting question, this, actually. You think it should be a simple answer, but you will find quite large companies lurking in some mid-cap funds. But for us, we're very purist. We look at companies which are in the majority in the mid 250 index here in the UK market. And there, I just did a little check before I came up to record this. And there, the market cap would be roughly between £450 million and £4.5 billion. So that's the number of shares times the share price. That's how we're calculating the market cap. So that's, 10 times. One is at the top end, you've got companies that are 10 times the market cap of the ones at the bottom. So, some people might consider those to be small cap, anything sub 500 million. But that's where we are at the moment. And that's obviously in pounds sterling for any US listeners. So try to be comprehensive with the answer. But, you will see companies up to maybe, I would say, up to $20 billion in some mid-cap funds, badged mid-cap. And, in our funds as well, we will hold companies sub 450 million too occasionally. But the sweet spot is probably, I'd say, between 1 and 3 billion.
So just to sort of give us some examples of the kind of companies we could be talking about.
Well, there's a huge range, actually. That's what makes UK Midcap so interesting. We identified 89 different sub-themes among the 170 operating companies. So that's the FTSE 250, excluding investment trusts. So then you've got the operating companies, which are the ones outside of those investment trusts. And they're in all sorts of, different growth niches. You can, go from the companies which, do pork and poultry, the one called Cranswick, and I'll talk about that a bit more in a minute, to asset managers, maybe, for example, Man Group, to really interesting engineering companies, to telecoms companies. There's a multi-utility company called Telecom Plus, which is quite interesting, and all the way to staffing companies, retailers. So you've got a huge amount of different growth niches, and actually what you don't really have much of, it's sort of what we don't really have in mid-cap, and that's probably more interesting to talk about, is those big sort of mining companies, companies that are massively exposed to commodities, more sort of macro factor companies. So it's more companies which are more in charge of their own destiny, I would argue, in the mid-cap zone, which is what makes them so interesting, and I would say easier to steer in some ways. I mean, I'm not saying it's easy, but less of a macro effect on both the share price and on the trading of the business, I would say.
So when does a mid cap become a large cap? Because I know Games Workshop, for example, is one of your top 10 holdings. It's just been promoted to the FTSE 100. So does that mean it's suddenly a large cap?
I think that's a really good question as well. It's a bit like, it's not like Kevin the teenager, at midnight when he turns 13, he suddenly starts acting a bit different. So I wouldn't expect that with Games Workshop either. So actually their midnight will be either, I think it's the 19th or the 20th of December, or actually it might be the 23rd, the Monday, the 23rd. So you get the announcement. You get the sort of anticipation, then you get the actual announcement of what's going up and what's coming down. So, you got B&M, for example, is coming down, Vistry is coming down, the house builder, and Games Workshop's going up, St. James's Place is going up, and a couple of others as well, a couple of other moves, and that's at the top end. So what happens is that it gets included in the FTSE 100 index. I'm presuming it won't do a Kevin the teenager. It will carry on being an extremely well-run company. Just to give you an idea of the returns we've had there since the current CEO took over, you've had a 25 times return for that share. So it's been a superb performer over the last 10 years, and thoroughly deserves to get into that blue chip index. So for those who don't know the strategy of the trust that we run here, the Schroder UK Midcap PLC, our unique selling point, or point of difference really, is that we will, all things being equal, sell when and if companies get into the FTSE 100. And that means that the portfolio is refreshed and is more often than not an excellent sell signal. So some examples I could give you are Royal Mail, which we sold twice on promotion to the FTSE 100, then it fell out again, or the company formerly known as Royal Mail, actually, currently involved in a takeover bid. But also Renishaw, for example, went into the FTSE 100 at £68, currently £34. So it does tend to be quite a good time to sell. But I will also say that it doesn't make us a forced seller. It's often the best thing to do, but it won't always be. So other examples I might give of companies that have gone into the FTSE 100 that it would have been the right thing to do to sell would have been, Vistry or Frasers as well. But I don't think, in investing and in company, there can be different companies which are you can take a different view just depending. The facts change, and you take a view depending on those facts and how they've changed.
Because I suppose for some people it might seem counterintuitive to get rid of a company just as it seems to be doing incredibly well. But on the flip side, it then opens up for you to invest in companies which you see following that similar trajectory.
Yeah, and I think often when companies in the portfolio are promoted into the FTSE 100, and we've seen it, across the 9 years that I've been involved in this fund, but we've run the strategy for 21 years. It's got to maybe a 3.5-4% position. So, there's then a significant portion of the fund can then be refreshed, and it forces a bit of a rethink. But you look at things like the valuation at that point, at whether whether they've done an acquisition to get into the FTSE 100, what's driving that move, or has it been natural organic growth? But I would say, yeah, why leave when things are going well? But sometimes it's best to, leave a bit on the table for the next investor. And I think, value investors would say that, for example. I think it's just depends on on that particular situation.
Let's focus in now then on something which has been in the news, well, pretty much every single day since we had the budget, and that's the increase in national insurance. We've had updates from company after company, many of them FTSE 250 companies, warning about the potential impact of those increases. How are you factoring that in?
Yeah, and it's been those companies which have a lot of staff, maybe a lot of part-time staff, less automation, sort of high service element, that will say that they're being the most impacted. But it's very varied, and actually in the mid-cap zone, companies tend to be more established. They're like well into their middle age, best age to be, I would say. And they're, they maybe have done a bit of automation. They've anticipated this is coming. Labour hasn't been getting any cheaper, generally speaking, anyway. And I did mention Cranswick earlier, and that is an example of a company that maybe would have been exposed to some of the lower wage, more impact, and could have been more impacted by national insurance had it not already gone down that automation journey, and started, having machinery from an interesting Icelandic company called Marel, which help in, let's just say, in say butchering, for example, where you need quite a lot of physical strength if you didn't have that automation, or in searching for bones in cooked chicken, because they do poultry and pork. So, I think high levels of automation are going to be key to battling that. And, you can see it in companies like M&S, which isn't a mid-cap, was, happily for M&S promoted back into the FTSE 100. But, you can see already at Waterloo Station, for example, one of the busiest M&S stores in the country, all those tills, people have got very used to self-service as well. WH Smith as well, self-service there too. But, you have companies which have given specific examples of how much they think the NI change is going to cost them. Because, of course, it's not just the rate that's gone up, it's the threshold at which employers will need to pay the national insurance has gone down from 9,000 to 5,000. So you can't expect that maybe people who were doing part-time hours and the employers weren't paying national insurance for them, they may now be asked to do more hours potentially, because if you're going to be caught up in the national insurance anyway, then maybe you could be asked to do a few extra hours. So I think it's something that we are having conversations with all our companies about, actually. And I think, we'll only see the impacts gradually over the next year. But the ones that have been doing quite a lot of automation already, and have already looked at the cost of labour, are ahead.
It's funny that you say that, because I must admit I've been into a few stores recently and thought, oh, where have all those automated tills come from? That's new, but it's a simple explanation. Look, we've also been hearing a lot about Donald Trump, his return to the White House, tariffs. Obviously, that's a word that he says he loves, but for a lot of businesses, a lot of economists, it sends a bit of a chill through us. a lot of the revenue from the companies, these mid-cap companies, is generated from outside of the UK. So have you been making any changes? What are you thinking about there?
Yeah, I think that's a really good point, actually. It shows you your understanding of the mid-cap zone in the UK, because half of the revenues, as you say, come from outside the UK and half are domestic. So you can tilt the portfolio very much into the domestic area, and a lot of the retailers, construction and so on would be there, or you can look outside. So, I mean, what we're asking our companies are questions like, those that you sell into, where are they located, and do they then sell on to the US? You have companies that have already been thinking about this. They're thinking, where would the worst tariffs potentially lie? And I think, some people were quite surprised that Canada was actually mentioned as maybe suffering from, having the higher tariffs imposed on it. I don't think anybody would have actually been expecting that. So I think it's companies which were already looking at having their supply chain quite dispersed at places other than China, because it would seem that China will suffer from the higher end of the tariffs. And they, management, I think, had already been sort of anticipating that this might come in many cases. I think the good thing is that most people would expect that the UK might possibly be in a bit of a sweet spot itself when you look at tariffs relative to, say, Europe, because it has its own more independence in terms of being able to negotiate on trade. It might be able to be a bit more nimble and fleet of foot in regards to bilateral negotiations on trade. But I think anyone who thinks they can forecast what's going to happen here, that they probably should start by assuming that that's not possible. But I wouldn't. I'm not making any preemptive changes. I think because the Chinese economy had been weak in the past, in the recent past, naturally the exposure to that weaker area had been lessening anyway. So if you kind of see that as the main thrust for the tariffs, then that is a smaller part of the portfolio than it would have been in terms of any exposure in any case.
Almost impossible to try and figure out what Donald Trump might do. Even when he comes out and says one thing, chances are he could end up doing something else. Such is the volatility of him being the president-elect. But also we've got volatility in France at the moment. And I have seen quite a lot of people saying that potentially that presents an opportunity, mid-caps, UK companies in general, just because we've now got stability here in the UK politically.
The UK has turned out as we would have expected it in terms of the new government and who's leading that. I would say some of the measures aren't exactly what people were anticipating. I don't think people anticipated any sort of big bang with the budget, and actually there have been some bigger than expected announcements. But outside of that, and we talked about the national insurance one, but outside of that, yes, I mean, what's happening in France and Germany as well, why don't we mention that too, is making the UK look relatively more attractive. And I think if you look at, for example, the OECD's forecast, you can choose which economist forecast you want to look at, but the UK is forecast to grow its GDP third fastest among the G7 next year. So I think that stands out as, the GDP growth doesn't equal economic growth, but if you think half the revenues are coming from inside the UK for the mid-cap set of opportunities, for example, that should help to underpin that. So in the least ugly competition, probably in terms of our near neighbours, we're probably up there on the top three boxes. And I think maybe seen as a bit more stable and predictable. I don't think I want to say what was it? Secure and stable. I can't. There were a couple of catchphrases that should be avoided. Strong and stable. That was it. But I think there's a team in place, and we know who the team, who's on the team, and we know who's going to be negotiating with external parties. And, but I think it's fair to say that having been in opposition for a long time, the government is still finding its feet. And you'd expect that, having, not being at the centre and being in opposition, it's probably natural to be still finding their way too. But yes, relatively speaking, there should be an opportunity for the UK as a place to come and reside, and as a place to build out your business relative to elsewhere.
Least ugly. I like that. Jean, this is our last pod for 2024. So with that in mind, let's look back. For you, what do you think has been the most exciting sector for 2024?
I think that financials have actually been a very exciting sector. And I think that's because a lot of them were on, and still are actually on, quite interesting valuations. If you looked at, I just had a quick look on my Bloomberg machine, and as you might expect, earnings revisions have been best rewarded year to date in terms of performance in the mid-cap arena. But in second place has been value, actually, and value, often financial stocks score well on value, partly because I think they can be difficult to forecast. You can get big moves in earnings in that sector in particular. But there are stocks like Just Group, which is a bulk annuity purchaser, which have met their financial goals. This one in particular has met its financial goals 2 years ahead of time. And I think that's in stark contrast to others, and maybe some of the industrials, which have had a much tougher year, which have had to push any sort of recovery out, and PMIs have been difficult. But then, happily, we've had a couple of these stronger financials in the portfolio, like Just Group, which I mentioned. Another one which I could mention is Paragon, which is a buy-to-let lender. And that might not feel that obvious, actually, because it might feel that we're taxing landlords into into disappearance, maybe. But actually, professional landlords is who they do mortgages for, and they're very good at it, and have been doing it for a very long time with a very high return on tangible equity. In fact, top of the sector. It's been a great year for them as well. And they've both been buying back shares, particularly, Paragon's particularly notable, I think, in terms of buying back up to 20% of its equity over the last couple of years. And that has been earnings accretive for them. So I think that is where some of the excitement has been this year in that financial sector.
Let's just round it out now then with 2025. Get your crystal ball out. Where do you think opportunities lie? And conversely, where do you think the pitfalls might be?
I mean, I've got to say, I'm going to say UK mid-caps, isn't it? Where do the opportunities lie? I think the reason for that is that on a relative valuation level, if you look at where we were at this time last year, we were looking at that gap between the US and the rest of the world, particularly the UK. And what's happened there is that the US valuations have climbed out over the sunroof at this stage, and the UK is still in the footwell. And I think, the quality of the company shines through. There's many companies across all different sectors. And I mentioned 89 different investing themes, from, buy-to-let mortgages to defense to some retailers, which are able to grow their top lines at, mid to high single digit. Many themes, and some asset managers, for example, Man Group, growing their earnings at 20% compound forecast over the next 3 years, using buybacks with great effectiveness across many sectors, and particularly in financials. So I think you see the opportunities as being great in UK midcaps, because you're getting the growth there. You've got 20% earnings per share growth across the index, what that's forecast for the year ahead. And you contrast that with sort of low single digit, for example, if you're looking at the FTSE 100, which is probably less in charge of its own destiny because of the macro that's involved there. But where are the potential pitfalls? I did mention defence. It's I think it's one to be careful of, because there's quite a lot of uncertainty around that at the moment, and in some areas you have regimes changing, for example in Syria, and I think the geopolitical area is where you need to be probably watchful, and probably maybe get more exposure to these companies with these micro growth trends, with their sort of niche markets. But I think, the pitfalls are everywhere in investing, and that's what makes it so exciting. And, I think you can't just assume, that rates come down, but, the Bank of England still talks about gradual rate decreases. So they're still talking about that the path is expected to be downwards. So you've got to see that with the FTSE 250 being extremely interest rate sensitive as the opportunity for the year ahead. For that reason also, but you want it to be, you don't want to see growth, sort of brought forward from the budget, which was raising more tax and raising the spend in the public sector. You don't want to see that, causing interest rates to then be the interest rate cuts to slow down. So you want the best of all worlds. But I'll be interested to hear what other market commentators are saying about the potential pitfalls for the year ahead. And I think the list is going to be as long as your arm, as it is at the end of every year.
So that was Jean Roche from Schroder Midcap. So thank you very much for everyone to listening. We're bringing to a close our final episode of the year. We've had a really good time this year. We hope everyone's enjoyed it. We've had some brilliant people on. We've had some amazing discussions, plowed through 2 million downloads. So thank you everyone who's given us their time to listen to it. Obviously, if you've got friends and family, give them a nudge if they haven't listened yet. And as Danny said, the pod will return on the 9th of January, where Charlie and I will bring you up to date with what's been going on over the markets over the Christmas period. We'll take a look at any of those early trading statements, see how some of those retailers done. Plus, Danny's going to be chatting to Dan Weller from Octopus UK Future Generations Fund. Until then, have a very Merry Christmas and best wishes for the new year. Thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.